Welcome, ladies and gentlemen, to the second episode of Buy the Dip. I'm very excited to have with me today Ryan Paisey, renowned market commentator. And if you're not already following him on Twitter, you really should be, because you get everything. You get geopolitical, finance, institutional research, and some of the best memes I've ever seen. I'll be putting his username, Twitter username, in the caption when the video is uploaded. So without further ado, Ryan, we're going to stick to the script here in terms of how we run the show. It's going to be basically, we're going to ask a little bit about your background. You're going to tell us a little bit about yourself, and then we're going to discuss some key market themes and questions which I think viewers would be interested in. And then right at the end, you're going to share with us your trade idea. So without further ado, Ryan, tell us a little bit about yourself, how you got into the world of finance, a bit on your background and what it is exactly you do, as well as this mystery of your Twitter username.
Right. So thank you for having me. It's a pleasure, privilege even. So my background is, first I've been in the markets for pretty much about 20 years. It might be a year over, it might be a year under. Started off as a runner, a company called the Kite Group, they were kind of big locals group on the life trading floor. Well, that's for those that don't know, with all the shouting and the hand signals. And I joined them just a year or so after that the floor disbanded and it all went back to screen based. So I went to screen based for the first time ever. But it was very much that whole pit trading kind of environment was still there, because obviously a lot of the trade, 90% of the traders there were ex-floor trading guys, so it's quite boisterous, and there wasn't too much finessing around. It was just lots of swearing, lots of should we say colourful kind of colourful environment to be in. And as a runner, it was awesome because you learned a hell of a lot because you were around traders all the time. It was also quite distressing, obviously, because back then there was no HR lady to go running to if you got bullied, and I got bullied quite a bit. So yes, that's how I started. And then after a couple of years, you'd say a year and a half, 2 years, I got given a trading account, and I was told basically you can trade whatever you want as long as you can give us a reason for it. And that was about the time that the IPE floor, which was the oil trading floor in London, they were just going to screen based. So it felt, bearing in mind, I've always had a massive fondness for geopolitics. The oil trading oil seemed like a good fit because I like the geopolitical nature of it, rather than say trading gilts or something which following central banks and interest rates. That's not for me. So I started trading the oil markets quite early on. Thankfully, touch wood, did very well doing that. Then I moved on to Henry Hub, where my claim to fame was I was Europe's biggest Henry Hub trader in Europe on the ICE exchange. Mainly because I found a little loophole in the fact that they were using not the best matching engine. So I was generating prices as a matching engine myself pretty much. And that was a carve up for while it lasted. And then since then, I've done some broking, I've done some market making, both options and futures. Basically, I've done pretty much everything in between. And after a few years back when I was just kind of burnt out, maybe also just had enough of trading, as much as I used to. I know I don't look it, but I'm 37 now. Decided to get more into kind of the market commentary, market analysis game, purely because, as everyone knows, I can talk for England. I'm never short of anything to say, so I might as well tell people what I'm thinking. And if I can build a business around that, then happy days. So the reason I started as Priapus IQ, I used to tweet a lot through my own personal account, but that was a mixture of me talking bollocks about sport and then trying to talk about markets, which I needed to separate the two and give one a bit more clarity. So started off with Priapus IQ, and the reason Priapus came about is a few years back. When I was doing some market making, we had a little market making firm. We were trying to come up with a name for that. And one of the older guys said, oh, if in doubt, you just go through the list of Greek and Roman gods and you just find one on there that sounds good and that's your company name. So we spent a few days, obviously, whilst we're not working, so feet up on the desk, trying to work out what god, we're going to pick. And I stumbled across this god called Priapus. And the long and short of it is, he's a fertility god and all that stuff. But basically, every depiction of him, he has got a massive cock. So straight away, obviously you're thinking, well, that's what we've got to call our company. Obviously, that wasn't voted in. I was outvoted massively. They're like, Ryan, you can't do this. So I've always had it in the locker at the back of my mind. If I ever start a business, I'm going to call it something related to Priapus. So Priapus, but obviously you can't just call it, I'm not going to call it Priapus Markets or anything like that. So just PIQ works, as in Priapus IQ. It's like meant to be intelligent. I'm not sure if I can pull that one off too much, but so that's pretty much my background. And
was it ever, Ryan, like in your family was your dad a trade or anything?
Oh, no. So I grew up in Somerset. I'm the son of a big publican family. So I grew up in a pub, which probably explains a lot. But yes, but I knew from quite early teens that I wanted to work in the city, wanted to become a trader. The only trading you're going to do back in Somerset is cattle trading. It's going down the market maybe, but
lean hog futures, huh?
Yeah, exactly. So that's why I moved to London pretty much straight out. I didn't go to university, moved straight out of college to London to look for a job as a runner. Basically, I knew I had to start at the bottom because obviously no university degree, and that's and then rolled on from there. And look at me now.
Look at you now. Alrighty, well, that was a very colourful and interesting background. I'm sure the viewers found that incredibly interesting. I know I did. So moving on to the next question. So knowing what you know now, what is the one thing you wished you could tell mini Paisey when you were starting out?
Number one, learn to be a plumber. Learn a trade. It's far easier money than trading. If you're listening to this or watching this and haven't started trading yet, it's not too late. Learn a trade. Electricians, everyone needs an electrician. Trading is far too hard, right? So that's number one. I know it's not the answer you want, but it's the truth. Maybe a more serious answer is if I knew that complacency killed as much as it does, I would probably be a lot more successful and have a lot more money. But the serious answer is complacency does kill. And if you have an edge and it's working, whilst it's working, start working on your next edge, because whatever edge you have over time will be eroded. It's not a question. Price discovery is so hot, it's so easy now. If you happen to stumble onto something that does make you money, it won't last forever. And it doesn't matter if this is just a very simple way you're making money, or if you found some very technical, quantitative kind of algo, whatever that makes money. Whatever it is, the edge will be eroded. You only have to look at the likes of Citadel and whatever, and see that is such an arms race between them now, and like the HFTs, that it's like I liken it to F1. So F1, 10 years ago, maybe £1 million or $1 million, £1 million worth of R&D might get you half a second or a second quicker on a lap. But now you need 10 million of R&D to get a 100th of a second extra. And it's the kind of diminishing returns on all these kind of edges that you've got. So whatever you're doing, if you're making money, fantastic. Work on the next thing that will make you money.
Yeah, I think that's actually a very good point. You got to be looking where the puck's where you want to shoot the puck.
Exactly.
Not where it is
it was like Gretzky, wasn't it? Look where the puck's going.
Yeah, that was it. Alrighty, that was very interesting. So what are some of the biggest tips that you could give to new traders, as well as major pitfalls to avoid? So obviously you've just given one. That was a really big one.
Yeah. So other than, keeping, going where the puck's heading, zoom out. And when I say zoom out, I mean both in terms of your trading horizon and like your information radar. So especially for kind of new traders, you see everyone's looking at everyone wants to day trade, mainly because everyone wants to trade. When they first start, they're a trader. They feel like that means they have to trade. And that means they have to trade every day. That's not true. It's far easier to make money if you're zooming out in terms of your time frame. Because I might think I know where cable's going to go in 6 months. I can't tell you where it's going to go today. It sounds obvious, but you see when traders first start, they almost want to be on every move. And if you do that, okay, fine, you're going to have quite a few winners a day, but then you're going to have a lot of losers during the day as well. And it's something that you can't carry on doing. It's, one, it's too intense, so you will burn out. And two, it's just, in terms of being profitable, the most profitable traders I know became more profitable when they zoomed out on their time horizons because it just makes life so much easier, because you can afford to be, because you're looking more medium, longer term, your position size, it might be smaller because you're looking for bigger targets. Therefore, you can wear that intraday noise. And it's the intraday noise that kills new traders. So that would be the main one. And obviously, when in terms of information, zooming out on your information radar, what I mean is if you trade, one FX pair, so many times you hear people that say, oh, I don't care, like something's going on in Europe, or I don't care about that because I only trade, say in the EU, so something's going on in the EU. They say, oh, I don't care about that because all I trade is cable. Well, it doesn't matter if only you trade is cable. It's all interconnected. So I'm not saying you need to be an expert on the ECB, just have some background knowledge of what's going on there. And saying, it's the world is becoming increasingly connected. So it's imperative that you have some sort of just a working knowledge of what's going on, be that central banks around the world, be that geopolitical events that are going on, elections in places, or, whatever, regulatory changes in, say, China or whatever. I really do believe that the more rounding you can get on kind of your intake of information, the better you'll be, because also it will generate opportunities for you, because you might see something also, you've read scanned an article on coffee prices, or like the Brazilian weather and how it's going to affect coffee prices. You may have never traded coffee before, but you may think, okay, well, I'm going to put on a tiny position, just dip my toe in, and next minute coffee's up 25% on the day because there's huge Brazilian frosts. It's, you need to make the idea of the game is to make money, right? And the only way to make money is to find as many opportunities as possible. Now, if you're zoomed in on one contract, on one source of news or whatever, you completely restricted the chances of you generating an opportunity. So that's, zooming out in terms of timeframes and information is the 1/2 biggest tips I can give. Biggest mistakes, well, the number one biggest mistake that every new trader will make is overstaking. One, forget leverage. It's, okay, so when I say forget leverage, as in don't rely on leverage for all your trading. There's some opportunities when you do need to go, full balls deep in a trade, because it might be a one in a decade opportunity. Say, there's something crazy happens. That's when you overstake, because you've got to make money whilst you can. But in terms of day-to-day trading, don't have any staking where you could ruin your account on 3 bad trades on the spin, because you will get 3 bad trades on the spin. You can't make money every time. So stay, unless an event calls for it, stay away from leverage. Keep your staking small enough that you're not looking to make, you're not looking to double your account every year. It'd be great if you can, but it's not how it works. We're looking to make 20-25% maybe a year. So that's and also one thing a mistake I do think people make is they get successful. They have they have a winning spell when they start on, like what I say, a shit hand. So they'll be trading poorly, but luckily making money. And then that only encourages them to make those same mistakes again. It's like, so I always liken it to poker. So, the worst thing you can do when you start playing poker is to, win a few big hands with 7-2 offsuit. The worst hand in poker. Because it makes all of a sudden, now you're thinking, well, hang on, I can win on 7-2 offsuit. if you play that hand 100 times, you will do your ass. So, it's believing that something is a good hand, even though it's not, and you've got lucky. And it's the same with trading. Someone might be trading atrociously, like making every error and, every mistake they can, but they might get lucky and win on a few good trades. All of a sudden, that's now, inground into their kind of sense of, self-worth, that they're a really good trader, and it's going to come and bite you on the ass. So,
because you'll get more and more confident, and you'll take more and more risk, when actually it could have just been pure market luck.
Yeah, exactly. You're getting confident in trading shit, which will bite you in the ass.
Alrighty, Paisey, that was a good, nice mix of pitfalls and tips for newbies. Obviously, this year, last year, and pretty much most of this year, to be fair, we still sort of, so much has changed. What in your opinion, are some of the biggest changing, emerging trends you're likely to probably see in a post-pandemic world as we emerge out?
This is a tough one, because, and I've been thinking about this quite a bit. I don't think we can get away from the fact that globalization has taken a bit of a pounding, and I think it will continue to. I think, the supply, the whole dynamics of the supply chains are, changed irreversibly now. I think the over reliance on China for just, and well, not just China, but like, let's say Taiwan for semiconductors. It's just, I think everyone, like the governments around the world, are waking up to the fact that, you can't rely on a safe, a safe supply line, really. So I think that will, I think we're going to see a lot more investments within countries and trading blocks to like produce their own, what's the word for it? But just like things that they used to import, they were now so semiconductors is the perfect example, right? So already we're seeing the US ratcheting up their semiconductor capacity. Same with Europe, are doing the same. I think that's going to continue. I think the whole, the world's going to go anti-China. It just can't happen. So it's those people are overcooking that idea slightly. But yeah, we will, globalization has taken a massive knock from this, and I can't see it ever getting back to what it, well, I say ever, in the near future, getting back to what it was. I also think the central banks have had another reminder that economic shocks are always just around the corner. So that will skew kind of the default kind of view more slightly to the dovish side. Obviously, it already had a massive dovish lean after the global financial crisis. It took so long for central banks to feel comfortable hiking rates and getting back into that mindset. And it was sod's law that basically we were just getting over that. And like we're talking about central banks and stuff, every central bank was live all of a sudden. They could, hike rates, they might not. And then this comes along, and it's just another, I think that whole rates lower forever, it's here to stay. And if you're a central banker, you're going to think, you're going to think long and hard about any like hawkish tilts and, like a hike cycle that we used to talk about, like hike cycles like they were nothing. Like over the next 5 years, we expect rates to go up, almost every few months. That's just not going to happen anymore. And also, it doesn't need to happen anymore. Businesses, like all sectors, it's like the banking sector, everyone's got used to low rates, and everyone has tweaked their business structure to accommodate low rates. We don't need high rates anymore. It's in terms of, what about inflation? Well, Japan have had like fuck all rates for God knows how long, and they can't get inflation for love nor money. I think there's a lot of outdated kind of doctrine about, you need rates, to control inflation, but I'm not convinced by it, to be honest. And so I think anyone looking for a rate hike cycle from one of the major central banks, I just don't think that's going to happen now. And I think that's going to be a trend for for years and years and years to come, that we're just going to be stuck on a dovish. I'm not saying rates won't hike, like small incrementals. But anyone looking for hawkish central banks, keep looking. It's not coming.
Not even from the New Zealand Reserve Bank, Reserve Bank of New Zealand.
Yeah, but like I said, major central banks.
I hope there's no Kiwi rugby players.
I can think of a couple people.
Well, that's really interesting on the globalization front, and I agree. I think there's going to be a sort of reconfiguration with supply chains, and just for like security of receiving, your goods and services.
Exactly.
You can't be reliant on only one country. But I think that's quite interesting that you mentioned that, because that sort of leads to the next question, where we keep hearing from central bankers that inflation will be transitory. So how does that sit with the god of fertility, Priapus? How does that sit? Do you agree or do you disagree with that?
He strongly believes that. Anyone that follows me on Twitter, it's no secret that I don't believe in runaway inflation, and I firmly believe that this inflation blip higher is transitory. That doesn't mean, again, like, it doesn't mean prices are going to come off, but it just means we're not going to keep this rate of increase. I do think it's hilarious how frothy some people have been getting on inflation, and it's each to their own, etc. But I look at the data, and if you look at the components of what, say, make up CPI data, and as Fed officials keep reminding us, like, constantly, nearly all of this inflation pickup is contained within a few categories. The primary one is being used car prices, and that's been a large proportion of CPI uptick is purely on used car prices and energy, but mainly used car prices. And I'm sorry, but used car prices don't continue to go up at the rate they have been. So there you go. That's your transitory kind of inflation blip.
And that was purely pandemic driven, wasn't it? Because people didn't want to be jumping on public transport, so they looked to bicycles and used cars. Used cars, obviously, out there.
There was a slight supply issue with because of the chips, but again, that's because the supply of the chips, which it was all supply and demand. You only have to look at last Friday's PCE data, which people forget, and you need to keep reminding people. PCE is the US PCE data is the Fed's preferred measure of inflation, mainly because it's not skewed so much by the likes of used car prices. Shock horror, the June month-on-month core PCE core reading was 0.4%, whereas the previous reading was 0.5. So not only was the estimate 0.6, which we missed by 0.2 of a basis point, but we actually came in lower than the previous. And now, if you believed all these people that saying, inflation, it's going to be massive, it's going to trigger the Fed to taper like aggressively, well, already we're seeing it dropping off. So I think that's, I guess, I believe a few prominent kind of supporters of inflation, obviously, are also prominent supporters of aggressive tapering and hawkish kind of Feds and so. But it seems like they've married that view. And if you just drill down and look, why is the CPI so high? It's pretty obvious that it's only in a few components. So I do fully agree that inflation is transitory, and I actually believe we've probably already seen the high prints.
Okay. Well, I was going to ask you, if inflation was to run rampant, what would be your hedge of choice, gold or Bitcoin? But I feel like, with your views, you've just shared.
Okay, well, say I am wrong, and say inflation.
Say the god of fertility calls.
Exactly. I know what everyone's thinking. He's never wrong. He's never. But if you need a hedge against inflation, and the choice is gold or Bitcoin, there's no choice. It's gold. Bitcoin has not been proven to be a hedge against anything. Okay, Bitcoin is not correlated to anything. It's maybe it will be correlated to something in a very short time frame. Again, zoom out and you realize that it's not. It was probably just kind of just a lucky kind of coincidence. I'm not anti-crypto. In fact, I've been pro-crypto since 2012. One of my good friends, ex-life trader, actually I used to be one of his runners. He gave up STIRS trading, so that's short-term interest rate products trading, to get into crypto in 2010 or whatever it was. So really early doors. He does a lot of he's got a lot of businesses running around that. He also set up a company called CoinScrum, which is like not a company, basically a networking organization, which is in London. And I've actually been long crypto since my 30th birthday. I got given a Bitcoin for my 30th birthday when it was worth about $50. Fortunately, holding on for dear life.
Jeez, 7 years going strong.
Yeah. Also, it's one of the things that I'm not quite sure how to sell it. So that doesn't. I just say it's too complicated for me. But yeah, so I'm not anti-crypto. I just think at the moment, I think the biggest achievement of crypto right now is getting central banks to seriously look at the future of money with their own digital currencies. So in a way, at the moment, you can argue that Bitcoin's biggest success will be its downfall, because if the central banks, which they are, they're taking it seriously, it kind of negates the need for Bitcoin. It's, yeah.
I think the only pushback against that, Paisey, would be that it's sort of, we go back to this whole argument about how Bitcoin is decentralized and the currency of the people, whereas, when the central banks create their digital currency, it's sort of centralized.
Absolutely. And it's a solid argument, but it's a great argument. The only thing is, you need big businesses of the world and trade to be done in whatever currency you want to be the global currency. And until we start trading barrels of oil in Bitcoin, it's going to be a hard battle to fight.
The new reserve currency, Russia's offloading dollars, they're going to change to Bitcoin.
Well, this is it. It's look, I'm not anti-crypto, but in terms of it being the new currency of the people, I can't see it. I think I think there's more chances that, in 10 years' time, the digital yuan or, digital dollar is going to be more likely the currency of the people. But there will always be, niche markets for crypto, like, be that money laundering or what. But I think
there's a lot of arbitrage that goes on. I know a lot of chaps back in my native country, South Africa, they like to arb the price difference because that price discovery, because it's still in its infant stages. But
yeah, exactly.
They try and obviously do that between the different exchanges. But enough about digital currencies. Let's get back to the main one. We've got a lot of questions to get through here, and I feel like we could be here all day, Paisey. So what's your dollar outlook and why? I'm a bit of a bull. I think I've made that quite clear in my analysis over the last couple of months. I just think from here on now, unless we see some cataclysmic variant, policy is normalizing and it's going to head in a northerly direction. I don't think we're going to get those aggressive hikes, as you were saying earlier, but I do think that the policy tightening fuse has been lit somewhat. So I'd love to get your view on it. So
I'm bearish dollar.
Well, you'd have to be, wouldn't you, because of your trade idea upcoming later?
Well, this is it. So on the medium to longer term, I'm bearish dollar. I was itching to get short at. Oh, hang on, what's going on there? Sorry, one sec. Let me just call up my dollar chart.
I think it's just below 92 at the moment, isn't it?
Well, I was itching to get short at 93.50. I put it on Twitter a few times. I just thought we'd take out the previous high a little bit, get some stops going and look to get short there. But unfortunately, never quite got there before the pullback. Where we are now, just like a couple of pips over 92 on mine. I think we see 80 before we see 100.
Wow. That's a big call. 80, eh? Wow.
Yeah.
So what's your reasoning behind that? Why are you bearish the dollar essentially?
So I don't tapering. I just don't think I don't think the FOMC, the Fed, are going to be as hawkish as many people think. And I think you got to for me, if they uptick rates, small after tapering, so that's not going to be until 2023, because tapering is going to take January, in my opinion. And they've already said that the rates won't, pretty much the rates won't be increasing until after. And also, those small increments in rates, because it's so known that is the end game, I don't believe that classes is hawkish. I just think that's like, you got to rebalance the scales and say, okay, well, neutral now is for a tapering leading into small increments in rate hikes. That's now neutral. Now, hawkish from here is if they decide to increase rates before tapering's over. Dovish from here is if they decide to not hike, well, basically prolong tapering by maybe only doing, say, 5 billion a month, whatever. But I think we have to, after each kind of, after every FOMC decision kind of thing, and know where they're standing. That's when we reset our like calibration of what's hawkish and what's dovish. I think it seems to be some people automatically think, okay, well, if the Fed are looking to hike in the future, that's hawkish. Well, it's not. It was before, but now we know that that's what they're looking to do. That now becomes our neutral zone. So yeah, I don't think we see, any hawkish surprises from the Fed. I also think that, there's a lot to be said for like China, like kind of increasing in their economic strength. And so I know they've taken a bit of a hit recently, but it seems to all be very much for like the longer term goals. I'm struggling to be excited about the dollar. Maybe I could quite possibly be proven wrong. It happens quite often. But yeah, it's not for me. I don't know. Maybe some of it's gut feel, but I just don't think we're going to get the hawkish reaction that many are kind of banking on.
So I suppose, my next question relates to, do you think, Jerome Powell safe in his position as Fed chair? And if he was to be replaced, that could probably support especially if he was replaced by Dove, that could support your bearish outlook. The
thing is, well, just kind of related to that. So my tapering timeline is unofficial nod at Jackson Hole, official details in November, the November meeting, which is the 2nd and 3rd, and then start in January at like 10 billion a month. So if they do 10 billion a month, and obviously we know there's 120 worth of purchases, that makes basically a perfect year of tapering. And that would fit in line, it's an easy thing to agree on. Okay, we'll just spend 2022 doing tapering. This is why I can't see any outcome where Biden administration don't give Powell the nod, because why, after everything we've been through, and we're now going to come into trying to the end game, the getting out of what we've got into in terms of monetary policy, why are you going to kind of rock the boat and change the chairman? It makes no sense.
Might be a political pressure thing from the Democrats potentially. Yeah, he is a registered Republican, isn't he, Jerome Powell?
But he's a Republican, but also he's massively helped out the Democrats. And in terms of the monetary policy, they did a lot. And if you didn't know Powell's political leanings, based on what the Fed have done under his tenure, would you say he was a Republican, or would you say he's a Democrat? He's throwing money at the problem. That's not what Republicans do.
And he's also speaking a lot about inequalities in the labor market for minorities.
Just because you're a Republican doesn't mean you're right wing and hate giving money away. Yeah, maybe he's a dovish Republican. But yeah, I just can't get my head around why people think there's a serious chance that he's going. And I think, well, recently, the whispers out of Washington all seem to point to the fact that the administration seem pretty happy to, just keep things as they are at the moment. Maybe after the tapering's done. They'll look to kind of influence in other ways. Don't forget, it's not just Powell that's coming up. We've got a couple of other Fed committee members that are kind of up for the change. So it's not all on the leader. And I just don't see the need for it, basically. But politics. I've just seen a headline from the Wall Street Journal saying Fed Chairman Powell's approach to regulation has drawn criticism from some Democrats. Oh God, the timing!
Well,
can we start again?
No, I think that was a good insight into your thoughts on it. And he has done a great job, saving financial markets, because back in the part of the pandemic last year, things were looking a bit.
But this is it. And so I didn't think they should have cut rates, because honestly, I was very vocal in saying it's not a monetary policy problem. But obviously, first thing they did. So I was massively wrong there.
I think it's just because central banks are a bit faster moving, aren't they? The fiscal, especially in America, it has to go through the Senate, and it's got. Well,
this is it. Also, I do think to a certain extent that they do get pressured in terms of everyone was calling for it. Even that they must. Yeah, I'm not saying they know it doesn't do anything, but cutting rates did not really do anything to alleviate any problems. It didn't cure COVID. You know what I mean? It's like. But,
Paisey, speaking of bonds and yields, we've seen some crazy moves in US 10-year yields. Do you think where they are currently, do you think they mispriced at these levels? Do you expect them to be higher or range bound? What's your view? Down low? Are they
mispriced? I haven't got a fucking clue. I don't. No one really knows I think obviously the reflation trade move that we had in the 10 years and all of that. That was balmy, and fortunately, I was saying that it's rubbish. It's complete crap. And it feels like it's almost like as fast as that reflation trade got put on, it's then got taken off, rightfully so. So I have no idea if it's mispriced where it is. Where do I think it's going in the medium to longer term? Obviously, everything I do is kind of thinking medium to longer term. Lower. It's no question. It's like trend is your friend with rates, and if you zoom out on that chart, it's quite a distinctive ski slope going down. I can't see the 10-year, unless obviously it's all COVID dependent or Delta variants, Omega variants, and all that crap. Unless something.
You should be well versed with all the Greek letters and the Greek
words. Mate, I can't stand it. Unless something crazy happens, I can't see us getting above 2% in the next few years. Obviously speaking a few years in advance is always like a minefield, because you have no idea. But trend is your friend, and it's lower. We again making a decision okay, where are we now? So the 10-year yields are 1.2, 1.23.5. I think we see negative rates before we see 2%.
On the 10-year?
On the 10-year.
Wow, that's a massive call, huh?
But this is I don't expect either to be hit within the next year or two. But if you had to say, okay, right, 50-50, which do you think is going to go first? I think pars get taken out before 2%. It's just the way the world is now. It's lower rates everywhere.
I suppose there is a view to support that, with all the debt slushing around the moment, can companies stomach or withstand a higher 10-year? Because that obviously feeds through.
Well, this is another thing. There's so much borrowing, right? That it can't really. I just think that they're capped, basically. Again,
quasi yield curve control.
This is it. Remember when everyone was talking about official yield curve control, and every meeting, are they going to announce it? Then it was like, well, actually, they don't really need to announce it, because it's kind of already happening. So are they mispriced where they are right now? No idea. Where are they going to go over the next few years? Down.
Okay, that was an interesting insight on the US 10-year yields there. We've got two big calls from the god of fertility, bearish on the dollar. And so we'll see 80 before we see 100. Obviously, we've zoomed out on that time frame. It's not going to happen in the next month. And then on the US 10-year yields, negative before we see 2%. So there are some big calls there from Paisey. Moving closer to home, got to come back and speak a little bit about our good old pound. So obviously that's going to be your trade idea, but some specifics maybe before you talk about it. Northern Ireland has flared up a little bit. It's a bit calmer now. It was a bit flared up a couple of weeks ago. Traders don't seem to be really bothered about that anymore. I didn't see any Brexit sort of related risk premiums being priced back in. Do you think this could be a potential blind spot? So that's question number one. Question number two is, this pingdemic. Thank God August 16 is fast approaching, because a lot of people, I think I saw 600,000 were told to isolate. And, that leads to obviously a little bit of a momentum slowdown, economic growth. How much do you think this could weigh on sterling crosses? I suppose if it's August 16th, maybe not too much. And then lastly, obviously, we've got the Bank of England meeting this Thursday. What are your views going into that? Could we see a bit of a hawkish surprise? Give us your views, Paisey.
So the Northern Ireland question, the Northern Ireland noise, I think it's just that. I think it's noise. We've already seen the EU have dropped the legal proceedings they were threatening. Sausage wars or sausage gate or whatever you want to call it. I think it's just a lot of bluster. And is it a blind spot? Well, quite possibly, because I can't see it being a problem. So maybe I'm blind to it as well. I think, we're going to get so much of this. And also a part of it is because the people that are kind of trying to still develop how we'll lead the Brexit situation, they break it down that they just need to seem important still. So this is why every now and again they kick up bits. It's just politics, isn't it? No one seems to have any real desire to really rock the boat. Both sides know that they need to, get to a situation where everyone's happy, or maybe the best situation will be when no one's happy, because if neither side are happy, then it's probably a fair compromise. I think the market's right to not get overly concerned about that. I think FX desks I've seen enough in recent years to know that there's a lot of bark, very little bite on these things. Look at Brexit. Everyone was fearing about no deal. I fortunately was one of the ones that's saying that there will definitely be some kind of fudge deal. It's the way it works. In terms of the pingdemic, it's an issue for the UK, but it was never going to be a straightforward return to the normalization. There's always going to be some speed bumps, and this is what that is. Will we see a dent in economic data on the back of the pinging? Yeah, of course, there'll probably be some kind of softening. I think we also have to kind of be honest with ourselves and say these numbers of people that have been pinged. Being pinged and self-isolating is not the same thing. There's many people that have been pinged. I will not confirm or deny that I'm one of them, with double vaccinations that are testing themselves before they go anywhere. If they've had double vaccinations and they have and they're testing negative and you've been pinged, it's up to you to fill out your details on your app. Many people aren't doing that. It's horrendous, obviously. I don't think it will have that big a dent on the data as some are estimating, because a lot of people seem to be estimating, a lot of people seem to be inferring that everyone pinged is self.
Yeah, that's actually a very good point, because I think a lot of people have got
that's not happening.
COVID fatigue, and they're a bit sick of it now. So
this is it. I was out the weekend, and it was pubs were back to normal. It was everywhere was busy. It was I was driving through central London on Friday. Big crowds outside Buckingham Palace. It feels like everything's getting back to normal. There's a lot of tourists around as well in London, especially. So I don't think it will be that much of a problem. And it will be buffed out going forward anyway. The government are already, like you said, August the 16th. It's all out the window anyway. And when you kind of look towards our European neighbours and whatnot, we're doing a lot better on the lockdown fronts than a lot of them. I'm not too concerned about it. In terms of BOE, central bank watching is not my strong. It's not my strong suit. I'm more geopolitical side of things and news and event trading. I can't see them being too hawkish. I think the fears of the Delta variant have kind of put a cap on any hawkishness that could be coming out. I think when you look to how lockdowns are going on in other countries. And obviously the central banks, okay, they're the Bank of England, but they will be looking at what's happening elsewhere. Obviously with Delta variant being the overriding kind of concern, I struggle to kind of envisage any hawkish surprise. I don't think it will be a dovish surprise either. I think this could be one of the, I know we get them a lot recently, but this could be just another meeting where it's just, sit on our hands, until the next one. And also, part of it is they probably want to wait and see to an extent what the Fed are going to do at Jackson Hole. Because there's a lot of the times central banks don't need to act because other central banks are acting.
I think a big thing for the UK, obviously, is also the Bank of England is the furlough scheme. How does the labour market adjust once that sort of support is withdrawn?
Well, this is it. And we've just had Sunak out whilst we've been talking, saying that just confirming that the UK has no plans to extend furlough. And to be honest, they shouldn't, because we are coming into the situation now where we're coming out of it, and like we're seeing in the US. Too much kind of support on the jobs in terms of job support or unemployment support rather. It's hindering the economy now because people aren't going back to work because they don't need to. So I think the Bank of England will want to just see, okay, see how that unravels. Obviously the house pricing at the moment, there was an article in one of the papers this morning, basically saying banks can't keep up with people wanting mortgages and stuff. We always say wait and see, but I really do think that the best angle of attack right now from the BOE is just sit on their hands and just see what happens. I don't know what do you think is going to happen on BOE?
I think I think the market's positioned quite hawkishly coming into this meeting. If you look at the OIS curve, it's pricing in about a 15 basis point hike by June 2022, and I think there is a bit of room for disappointment on that front if they are positioned quite hawkishly. I do think we will get at least. I don't think the vote on QE, the purchase program, will be unanimous. I think there will be at the very least one dissent, most likely from Saunders. But I also think it's going to be an interesting meeting in the way that we will be getting updated economic projections, and we will also be hearing, I think, the results of that review into using negative rates, which I don't know your views on, Paisey, but I'm very anti against negative rates. I don't think it's worked empirically in Japan, Europe, or Switzerland. And then the other last thing, which is quite an interesting one, is that sequencing the exit, which the House of Lords is applying a little bit of pressure on the Bank of England with regards to, quantitative tightening, reversing those asset purchases and winding down their balance sheet, which I think they might drop it to 1%, the threshold, from 1.5%. But if we were to see a 50 basis point threshold, I think that could be interpreted as quite hawkish. I think going into this, where positioning is, if we do see some hawkish surprises, we might see a slight uptick. But given that where we are in terms of where the market expects liftoff to occur, I think we'd have to see some pretty hawkish things to happen to meet those expectations.
I completely agree with you there. I think, like I say, I think we're going to, the usual significant progress needed and stuff like that is, I know it seems that's kind of the central bank kind of now buzzword is this significant progress. We're seeing BOE use it and we're seeing the Fed use it. Even the timing of the rate hikes that's being priced in,
it's quite hawkish that June 2022.
I do think there's room for disappointment on that. I understand that there is some argument that it's not, it's not just rate hikes that are being priced into that. There's also, some other factors. But I don't think we're going to get a hint on any timing on any of that. I guess maybe as BOE meetings go, it's slightly more live than normal because like you said, there is a room for disappointment. But when was the last time we had some excitement on a BOE decision day?
God, we need some. Lack of volatility, it's killing.
Maybe people are pricing in stuff just because they're thinking, one of them's got to be exciting. Yeah. So, well,
I suppose also, the inflation projections, that will sort of confirm the market expectations. If I think what could play out is we see that peak towards the end of the year, and then it sort of comes back down to target. Now, if we do see that, that sort of confirms the market's expectations on their rate path. But if we were to see that 2 to 3 year inflation forecast horizon towards the end of their forecast horizon actually above target, that could actually be potentially quite hawkish. And the market could bring forward that even closer within the first half of 2022. But anyway, enough about central banks. Let's get on to the most exciting question of the interview, your trade idea. So just share your chart with us, Paisey. Run us through basically why you believe that this is in your opinion, is the most likely to be successful, and why you most.
So before I share my screen, so I'm not joking when I say that my most confident trade that I think anyone can do is buy the dips in the spoon in the S&P.
Okay.
That's not a joke. It's the most profitable trade out there.
As it comes back down to the 50-day moving average,
people like to take piss out of it, but I encourage everyone to accept the simple fact that it works. Even though a lot of people hate it because it's too simple. Look where we are now. Look at every dip that's been bought. It's it's a no-brainer, and it's become a meme itself, but it's true. It is, but
it's the name of the show. Popular culture.
By the dip. I completely forgot. Perfect. Right, so let me just share this. Oh God, I hope I share the right thing. Huge is going up there. So cable. Great. Where we are now, obviously, it's no secret I'm a massive bull in GBP. As much as we Brits love a bit of self-loathing and hating on the government, the fact is we're handling the COVID situation much better than our peers. In terms of vaccine and lockdown decisions that were made, we're definitely we are one step ahead of the majority of other developed countries out there. Well, pretty much all countries. As me spending pretty much all weekend in the pub will testify. Can't do that in many other countries. So I think we'll see a relative outperformance in data compared to the peers. In terms of, I think we'll also see, going forward, maybe not this meeting, as we've said, but I think that will lead to, not saying that we're going to get a hawkish central bank, but I think the BOE chatter and whispers will come across more hawkish than many others. The best way to convey it, bearing in mind I'm, as we've said before, I'm bearish dollar. I think getting long cable, again, I don't know how useful this is to many people because obviously I only deal in medium to longer term. Where will cable go next week and the week after? No idea. But medium longer term, I think cable goes higher. I've put in, so the line here just at like 1.5 or just over, which was the 2016 kind of Brexit noise high before obviously we voted out. I think, there's a lot of people been waiting a long time to hit that target again. So my trade would be getting long. Well, if you have to get long, just get long here. Because our targets are so big, you're kind of looking at a decent stop. So I would say, you want your stop kind of down below, say 134. But my target is 150. When I say my target, that's not where I'd be getting out of all of it. It's like I would look to hold until at least there and then look for it to push on. I just really like, I think it's been a lot of hate towards cable, basically since Brexit, and the FTSE as well. Even though it's, the FTSE was more the 250, obviously, which is more domestically focused. There was a lot of money that got taken out and not, a lot of money sat on that wasn't used in the markets because of Brexit. And then just as Brexit got finished, we were looking at, maybe the money's going to come back, because it's been waiting there, sat on the sidelines. Then it didn't because of COVID. So I still think we still haven't seen that return of cash into sterling and return of cash into, say, like the FTSE 250 and that we have been waiting for since Brexit. I think it's very easy to forget that because we kind of think that there was a big gap between Brexit and COVID because it all seems to have blown, but it wasn't. They were overlapping. So I, as you can see on my chart, I'm not a fan of technical indicators. I love me a 100 and a 200-day moving average. And I have the Brexit target. It's also an element of perhaps gut feel, but I struggle to be bearish cable.
Okay, so just to recap, we've got 150, 1.5 as your target, and that is over a sort of 6 month to year, or we looking?
But come back to like Twitter, remind me in a year kind of thing. It's
and anywhere along these levels now, you'd be looking to sort of gradually dip your toes in.
Yeah, exactly.
Okay. And a level where you would sort of maybe start to think, hang on a second here, is the god of fertility made a mistake, would be around 134.
Yeah, because I would, so just in terms of like very basically, if I was trying to look at kind of where we could get to, obviously we could break this low here, like 136, just below 136, which we hit the other day. Then you got these previous highs back in 2019 and 2020. Every likelihood that we tag them, I don't think we'll get back. But if we get back below 134, then you're kind of thinking, okay, well, maybe this is, is that just a sign that this was the top of the range? From here to here, and then hit a lot of the bottoms here. So that way, maybe we come back down to 120, in which case, it's definitely off. But also the way I trade is I wouldn't have a resting stop at say 133.95. I would wait to see if we trade below 134. So 133, I would wait until we trade below 134. And then I want to see us actually sustain below 134 before I'd be cutting. It's I'm not one of these that rests stop in. Yeah. I think that's maybe another thing that maybe new traders can get wrong. It's they'll have a resting stop, but once the market gets there, you still do need to say, well, hang on, has anything changed? If nothing's changed and the market's gone down there, that's the market's moved, right? But if fundamentally something has changed and we're trading down there, that's when you decide to cut. I think you always have to bring into your thought process, why, not just where the price is, but what is the underlying nature of the market, that why might it sustain these levels? So if it trades below 134 and, maybe that's because the Fed are far more hawkish than I currently believe. And the BOE maybe more dovish than I currently believe, then that's when I'll be cutting out. But until then, I do think, just believe in the method.
Wise words from Mr. Paisey. Paisey, we've done a great show today. We've discussed a whirlwind of topics: geopolitical, central bank, FX, tips, tricks. Thank you for coming on. It's been really entertaining.
Thank you for having me.
I'm sure the viewers have found it incredibly entertaining too, and very interesting, and have gleaned lots of information from it, valuable information. And mate, thanks for coming on.